Okay, now we are recording. Let's get this show on the road. Okay, so as I mentioned, the 14-day Weirdor has been having some challenges lately because the choppiness. Oh, I will, Suresh, I will post the recording into the library file. I'm going to send that over to Tom, so it'll still go into the library of both the class page and I believe of the Aramir website library as well. So that will get transferred over to Aramir after the session is over. I think it'll probably, worst case scenario, it'll be there by tomorrow. I don't know how long it takes to crunch it all. So, all right, so as you can see here by the chart, this is the Russell 2000, and we've been having some extreme swings in the market. These bars are, like some of them 50 points, 45 and 50 point wide swings, intraday swings on a daily basis. Now, the way that this short term, in order to get this, the time diversification that I talked about with a very short term trade like the 14-day Weirdor is by being able to put one on every week. And, even though there's going to be some stumbles, there's going to be usually different types of markets throughout a month. So if you put one on every week, you're going to maybe skip some of those types of markets and hit other ones. So that allows for what I call time diversification. So each trade might be only handling a different type of market. Well, what's been happening recently is that we've been having the same kind of market on a daily basis where we've been having these really wide swings, as you can see here, especially through March, where we've had these 45 and 50 point swings on a daily basis every single day throughout most of the month. Now it makes these bars over here look smaller, but they're actually quite large as well. So we're still having 30 point swings. So we're getting a lot of whiplash. So what this means is that I have to make obviously adjustments to keep the trade viable and out of trouble as much as possible. But when we get that whiplash and completely revert in the opposite direction in a very short amount of time, which is what's happening, and then I have to reverse those, it becomes very costly. So what ends up happening is that because it's such a short-term trade and I'm making these adjustments, a lot more adjustments than normal on a very short-term period, it's very difficult to make up that cost of that trade. So where I'm not having any issues with the monthly Weirdor or the nested iron condor, which really loves these types of swings, it is causing trouble with a shorter term trade. So in order to fix this issue, I've modified the trade a little bit so it can handle these swings larger, but it's not taking away from when the market's going to be different than what it is now. It's still viable in all of the other types of markets. It's just that now I've made some modifications to be able to handle wider swings and still keep that short-term nature. So again, I've made these modifications to handle the swings in the markets that we've been having lately without taking away from the original premise of the trade. I've also made it easier to enter. So instead of, as you guys know, there's 4 pieces. One of them is just a single out of the money put, so it's not as important. But there are basically 4 orders that are being entered at the start of this trade, and I've changed that so this trade can now be started with just 2 pieces, and then I haven't done a lot of changes to the type of adjustments. I'm still using spreads for adjustments, so I'm trying to keep that easy as well. But I'm trying to make it easier to get into the trade and not have as much slippage that way. So I'm going to show that as well. And then the last thing is, because of the way I've made these modifications, it's actually created a way of lowering the planned capital or margin needed. So I can still, put the trade on with a $20,000 planned capital, but now I have the ability to, cut that in half or lower if necessary. So for people with smaller accounts, you can now trade this and look at it as, instead of a single tranche that's costing a $20,000 planned capital, you can put on a smaller number of contracts and actually lower that capital. So that's kind of a nice additional benefit of some of the modifications that I've made. So with that, I'm going to go into those modifications now. So let's get to it. All right, so this is the, I'm going to move, I'm not quite sure if I can make this a little bit smaller. There we go. I don't know if you guys can see this chat box, but it's kind of getting in my way here. But I want to keep track of things. So, okay, so this is going back in time to just the recent trade that we've had, which has gone through a lot of adjustments. The one that was for the 25th of May expiration. So that trade was started on the 26th of April. And as you can see here, this is the original trade with the original method of just my basic Weirdor structure. Here I am starting it out at 29 days to expiration, and it's got those four pieces. So I've got the main engine, which is the put credit spread, the put debit spread up here, the call credit spread, and finally that far out of the money put for, well, it's not that far out of the money, but the out of the money put to kind of flatten this out. So I start off with a nice flat T+0 line. I've got some, nice profit potential. I'm trying to take it into 14 days to expiration, and have some decent profit potential here, in hopefully a short amount of time. And of course, I have that if I get up to 2% plus profit in a very short amount of time, I'm going to want to take it off pretty quickly. So that's kind of the way that this trade was set up. So the difference is, if I look at the new method, there's actually two different ways of entering this trade that I've come up with. So this is the first way, which is going to be probably the most common. And basically what I've done here is created an even number of contracts for my put debit spread and my put credit spread. I've obviously had to change the strikes, but I've done it in a way where I'm still getting a good theta to vega balance and a good delta to theta balance. And I still have a nice flat T+0 line. I'm not taking in as much of a credit, but I've got more room to move here. And if I go to 14 days to expiration, I still have that nice ability to make a decent amount of money here. And as the market moves, if it's continues to move up, I can use some very simple adjustment strategies where I am just putting in spreads. So I can sell a put credit spread or buy a put debit spread if the market goes down, or sell a put credit spread if the market goes up, to kind of lift this right side of the graph. Or roll. I can roll the longs or the shorts of the put debit spread to deal with flattening out the delta as well. So very much the same type of adjustments that I was making before. So I'm not changing too much of that. The difference here is that this particular trade can be entered, I can still enter it as two spreads, but I can also enter it as one order as a put condor. It's not it's got the same number of contracts, and I can just have this entered as one. Whoops. If I were to repeat this as one put condor order, so I don't have to put in two separate orders. So that can make things easier. Just put it in as one order. It's a four-legged order, and place that order in Thinkorswim or Interactive Brokers or whatever your brokerage account is as one order. So that's a way of doing that. Of course, it can still be entered as two spread orders as well, but this is one way to make it one order. And then once that order is complete, then the second part would be to just add the call credit spread, which is again just going to be put on at the approximately the 12 delta for the short. And in this case, for a 5 lot, I only need one. But the difference here is that the width of these spreads can be different. So in this case, this is a 20-point spread, but I may have a call credit spread that's a 30-point spread that's higher up. And some of the distances between the spreads here might be a little bit different depending on what type of market it is and what kind of pricing I can get. So those are some of the things that won't be exactly the same every time, but it'll be very similar. So Basically, all I'm trying to do here is capture just a little bit of total credit, not like before. Still have a nice theta going in with some good profitability, capable of good profit within that before the 14 days to expiration, or taking it to target of 14 days to expiration. And in this case, with a 5 lot, I'm able to actually lower my margin by half. Now, as adjustments are going to be made in this, the only way, one thing to note is if the market continues to go up, and I have to maybe roll a long down or by basically selling a credit spread, that's going to bring my margin up. So for those who might have an account where you're limited in your margin, one way to deal with that would be to do it as a put. You're selling a put credit spread, put condor. You're selling a put condor. So that is one way to do it. It keeps the margin in check and still flattens everything out and still raises the right side of the graph. So as you can see the difference here. So that would be a way of dealing with the market moving up, raising the right side of the graph, and still being able to keep the margin current, not rising, by adding that put debit spread down below, or by putting it in as selling a put condor instead of just selling a credit spread. And this can be done by just 10 points, 20 points, depending on what is needed to flatten out that delta. So that is the way that one way of entering this trade. So what I want to do now is kind of go through that of how the trade has handled alongside the original 25th of May 14-day Weirdor strategy trade that was put on. So I'm going to go to the original one first. And we're just going to step through that and kind of see what happened and how many different adjustments were made because of the market swinging around. So this was entered on the 26th of April, and everything was kind of moving along smoothly until the following Monday. We had, everything looked pretty good in the morning, and then at the end of the day, we really sold off. So I don't know if you recall, but at the very end of the day, we had this sell-off, and my conditional order was triggered. So the trade doesn't look like it's in trouble or anything. It's still above the zero, basically break even at this point. We've had this big move down. So I think the range for that day, the high was, so the range for that day was about 22 points. So we had this, pretty nice move down, and it triggered a conditional order to put on a put debit spread, which was added here. So that's one adjustment that needed to be made. At that point, trade still looks pretty good. Got a couple weeks to go. There's still plenty of money to be made in the trade. Let's continue forward here. On the next day, actually in the morning, let's go back, we had that market moving down again, and another put debit spread was triggered. So again, the trade is still viable. It's not in trouble at this point, but I just had two pretty substantial adjustments. They cost a lot of money, and I don't have a lot of time to make that up as I do in a 30-day or the regular monthly Weirdor. But it still has some decent profitability here, and I can always raise that if the market reverses. The only problem is I don't have a lot of time. So let's go forward again. And let's just take it another day here. So I've already got two adjustments. And now I go forward. Now the market's really racing back up quite a bit. So it's really getting chopped around in the last few days. If I look at the chart, let's take a look at the 26th is when I entered this. We've gone from let's see, a high of 1562 down to a low of 1526 in just a matter of 3 days, and then back up above where it started at 1565 now. So, quite a bit of a range just for a few days, which is what's causing this whiplash and the need for adjustments very quickly, and then the need for those adjustments to kind of be removed, taking away profitability from the trade. So as the market started to move up here, well, now it's time to start bringing that right side of the graph back up by starting to roll up these put debit spreads and start to remove, starting to want to remove them. But being careful, because I don't want to take away some of that downside hedge in case we have another reversal, because the market's been kind of, severely choppy. So I'm bringing that right side of the graph up. But as you can see, it's, the profitability keeps getting nibbled away at more and more and more because there's so many adjustments and they're so costly, and I don't really have a lot more, I don't have a lot of time, for the target exit date to stay in this trade. So there's still profitability, but now it's kind of really getting whittled down. So by the end of the day on the 2nd, I've had to make a few adjustments because the market moved up, and then it kind of settled down a little bit. But I'm trying to bring back some profitability into this trade without getting it into trouble. So that's kind of what would happen. So if I count up all of those adjustments from the beginning of this trade so far, I had one on the 30th, which was a put debit spread, another one on the next following day on the 1st, which was another put debit spread because the market went down. Then on the 2nd, the market screamed higher, and I ended up having to make 3 adjustments just to roll up my put debit spreads and kind of remove a couple of the, not completely, but remove some of the adjustment I made when the market was going down. So I've had basically 3 days of adjustments, and the last day there was actually 3 adjustments. So about 5 different times I'm actually having to make adjustments here. So let's just go over to the trade had I entered it as a put condor instead. And I'm going to go back and follow it through. All right, so here it is at the beginning. As I mentioned, you can put this in as 2 separate orders. And let's just, go forward on this. So, end of the day here, didn't move too much on that first day. And Friday was okay, but what we know is that on Monday, at the end of the day, we had that really big down move. So as you can see here, let's go to Monday, we had that really big down move. Well, in the original version, it caused, it didn't kill the trade, but it certainly caused me to make an adjustment. In the put condor style, that's a pretty big move, but as you can see, it really didn't affect it that much because I got more room to roam here before something needs to be done. And so that's kind of what I was getting at with being able to deal with a more choppy market or more whiplashy market, which is what we've been having, and still have the ability to make a nice short-term profit, for this trade. So far I haven't had to make an adjustment even though we had that big move down. And if I go forward to the next day, as you recall, in the morning, it continued to go down more. And I'm still not at any need for an adjustment here on this trade. We're still looking pretty flat. If I go to the original, this trade is looking like it's just about ready to need an adjustment, which I did shortly after. Flatten that out. So again, the original one is not in big trouble, but it's kind of a pain because I keep having to make adjustments, whereas this trade I haven't had to do anything yet. And it's already up 3.2%. So in essence, it's kind of hit my, target. And had I used a current, a margin of 20,000 instead of 10,000 for this one, and did 10 contracts here and 2 contracts here, it'd still be 3.2%, but the dollar amount, of course, would be much larger. So and that has been in the trade so far for 5 days. That includes the weekend. So let's just roll forward here. Let's go to the end of the day. We're starting to move up. Let's go to the next day on Wednesday, and it's already showing up 4.4%. Okay, I don't really trust end of day prices here, so I'm not really going to look at that. But let's just continue forward. And now the market's moved back. Still making some profit. Here's my target exit date, about a week away. There's still profitability left in the trade, but I don't really want to lose what I've got. So in reality, let's say go to Friday, so a week before the target exit date. Let's see what this looks like. It's up 4.7%. Of course, there's going to be a little bit of slippage, but that's a pretty nice return. And let's say I wait, which I normally do, is I like to wait for the market to kind of settle. First half hour in the morning, let things kind of settle out. But here, at 7 o'clock in the morning on Friday, a week before expiration, a week before the target exit date, but maybe you want to take off the risk over the weekend, this would be an opportunity. Of course, it's already hit past my 2 to 3% target profit for a really quick profit. Been in the trade for 8 days. This is supposed to be a short-term trade. This wouldn't be a bad time to just say, okay, I'm done. And in a normal market, I might think, hey, well, we might chop around a little bit, but it's not going to be 50, 40, 30, 50 point chop in a day. So it might be worth it to stay in a little bit longer. But in this market, this would definitely be a good target to have been reached and close. So as you can see, the difference is I'm not bringing in as much credit, but I have a lot more room to run on both sides. And if the market starts moving up, I have the ability to raise this right side of the graph. So just as an example, I want to take this in a little bit further, because we know, of course, hindsight's 20/20, we know the market just continued to skyrocket up like crazy. So how would I handle moves like that? So like I said, normally this thing would just be gone. I wouldn't want to stay in it. I've made a nice profit in a very short amount of time. Even with slippage, that's still a good profit. I don't have as many pieces to take off and on, so hopefully there's not quite as much slippage. I've got my calls, and I've got my put condor here, so I can just actually, because there weren't any adjustments, I can take this off in 2 orders. And I can also remove it slowly to try to make sure that the slippage isn't as hurting me as much as the market kind of moves around a little bit during the day. So I might be able to just peel off one of these, peel off one of to get rid of the calls, peel off a couple of these, and then get rid of the rest, kind of thing. So that's a way to deal with that. The market moving throughout the day. But let's take this through a little bit further. So let's go. Let's just go to the end of the day here. All right. So now we've had this big market move. That's a pretty big move up here. I think about a 32-point move throughout the day. It's up 19 points, but just the range here is about 32 points so far for that day. So I would have made an adjustment. Probably would have done it a little earlier in the day here. Yep. So let's go back to, let's just actually go to, change my configuration to move to the previous next adjustment instead. All right, so I've made an adjustment here, and the adjustment, again, is just going to be very simple. I'm going to roll my, I can either roll the short up, or I can roll the long down, and just make it very simple by either, basically all I'm doing is selling a put credit spread. I can do, I can do a 20-point, I can do 10-point, something to get this to raise the right side of the graph and lower my delta, keep theta in the trade. My Vega's in really good condition here. But if I want to keep my margin the same, then I'm going to have to do a put condor. And basically the very simplest way to do that would just be to, make it even. If I'm going to do a 20-point put credit spread here, I'm going to do a 20-point put credit spread here. So basically, I'm going to roll this up 20 points. Oops, that's the wrong way. Sorry. Sorry about that. Dogs are going wild. All right, I'm going to put a put credit debit spread here and a put credit spread here. So obviously this one I'm going to get a credit out of this because the credit spread is going to bring in more money than purchasing that debit spread, but it's going to keep my margin the same. So that's how I would deal with that. So if I have a margin issue, I would just do it as a put condor, and if I don't, I could just do it as a just rolling the short down or short up or rolling the long down here. But again, I could just do it as one order. So that brings up the right side of the graph, makes everything nice and flat again. And let's just kind of move forward to see what happens next here. So next adjustment, market continues to move up. So now I've done the same thing, just another put condor to keep the margin the same. So the margin was 9,600, now it's 9,500. So here I've got half the margin, I'm up 2.8%. That's not shabby either, but maybe I'm looking at this going, well, I got another few days to go, maybe I can squeeze a little bit more out of this. So I was already up. This is why I would have taken it off at 4%, because I know that any of these adjustments that are costly are going to just keep bringing down my profitability, because I know I'm not going to plan on staying in this trade for much longer. If I wanted to take it into another week, it's a different story. But I really got to consider gamma risk, and that's what's been happening with these original ones that I've been putting on. They've really been challenging and kind of forcing my hand, and I don't want to be in that situation anymore, which is why I've made these changes. So let's go forward again. That was on the 7th. I don't know if there's any other adjustments before. This one is just, yeah, there is. Okay. So, all right, so now again, having to make another adjustment. Again, all I'm doing is just putting, selling a put condor. Or if I didn't need the margin, then I could just sell a put credit spread. And another thing I'm looking at are these calls. I can also remove these calls. So at some point here, that is one of the things I'm going to do. They're getting too costly and it's getting too close. So I can roll here. I roll up the short of the call, as well as doing a put condor again. So the trade's still up, but again, I had a much better opportunity to get out of this trade a lot earlier. So now let's go 9th. There's one more. Again, the market continues to move up. Make another adjustment. I still, now at this point though, I don't have a lot of protection for this put credit spread here. So at this point I probably don't really feel comfortable keeping this going anyway. So yeah, exactly, Michael, you bring up a good point. The P&L is really getting crushed, and that's one of the reasons why, because it's such a short-term trade, when profits come in, unless I can do something to really raise this up in the short amount of time I've got left in the trade, which is only 2 days if I take it all the way to the target exit date, there's really no reason to stay in it. There's really more of a reason to get out early, which is why I mentioned that when it was up 4%, it would have been much better to get out then, instead of taking the risk of the market moving in a way where I had to continue to make adjustments. Now, if the market wasn't moving as erratically as it has been, then maybe I might decide, I'll take it in a little longer, try to make more out of it. Because of the way the market's been moving lately, the risk reward just wouldn't seem worth it. And it's more work. So at this point, let's go back to the start of the day. So at this point, it's just not making, I'm able to stay in it a little bit longer. but I'm kind of limited because now if I take it into that target exit date and I don't want to go past it, I'm just going to say, okay, let's let some of the theta bleed out throughout the day, let's say, and at some point, here, just take it off. So actually, I'm still, a decent profit. It's nice and flat, but there's just no reason to keep it on any longer, and I'm at my target exit date, so it's time to take this off. So even if I took it into the target exit, that's how I would deal with the market moving up that much, is by just very simply selling put credit spreads, and then if I need to deal with the margin, buying put debit spread. So basically, in essence, just selling a put condor. And then if I need to roll the calls or roll up the shorts of the calls or remove them at some point, keep an eye on that as well. So that is the main new way that I'm going to be trading this. So you have less pieces to start with and to deal with, and keeping the adjustment style very simple still. Michael asked me a question. When the market looks this choppy, do you ever just throw in the towel and wait for the waters to calm? Yeah, that's kind of the way I'm feeling with the current methodology, to be honest with you. Normally what I like to do is I like to try to be, in order to get a good expectancy from any type of income strategy, it's usually best to be consistent in the entry, unless there's something absolutely crazy happening, and I guess we could say that's happening on a daily basis, at least in outside of the market with the politics and geopolitics and all that kind of stuff. But most of the time, it seems it's usually just better to just, if you're going in at a neutral type of trading style, to not try to guess which direction the market's going and just enter the trade and manage it accordingly throughout. And overall, the expectancy should come out in your favor. And that's kind of what the strategies, the nested iron condor, the monthly Weirdor, and the 14-day are supposed to do. So over time, yes, I'm going to have some losers, but the expectancy is going to be that the winners are going to be a lot more than the losers. And if I don't try to guess which way the market's going to go and just go in as a neutral stance and just be very consistent in entering the orders and managing them accordingly, that I should end up ahead. Now what's happened is this 14-day, talk about bad timing, the 14-day strategy in starting the service has really gotten off to a crazy start with all this chop. It's really taken a hit, which is of course what's caused me to make the modifications. So what I realized is that although it works really well in the monthly version, because I have more time to kind of make up some of these adjustment costs, it's just a little too much craziness for a short-term trade. So that's why I've made these. So let's see, Norman asked me, with the new entries, how far out OTH do you look for the short put strikes? It's going to depend. So I'm kind of, volatility is going to play a piece in this. So it's going to kind of depend on what kind of, I want to get a small credit going in. So, but I don't want to be, if it's a put condor style, I don't want to be, past like a 25 or 30 short delta on my short, the closest short put. So that's probably where I'm going to be looking to put the closest short put. It's going to be probably around a 25 delta on the puts. And then the calls, the short put's going to be around a 12, just like it normally is, around a 12. It could be a 10, it could be a 13, but it's going to be around a 12. Michael's saying 50-point swings and the rut would qualify. Yeah, absolutely. And that's kind of what, that's what I'm trying to do here. I'm trying to make this, it's able to handle, normal choppy markets, and if the market wants to go up or go down, it can handle things. But I really needed to figure out a way to deal with these extreme wide swings. And it's not so much that I can't deal with these wide swings. Let's go back to the graph here like this. It's that they're happening on a daily basis, and they're, so I'm stuck making an adjustment to the downside, then all of a sudden I'm stuck making an adjustment to the downside, to the upside, in sometimes an intraday basis, if not like a daily basis. And that just takes away so much profitability from the trade, especially the short term, that it's causing trouble. Now in the nested iron condor, I'm thrilled with that kind of movement, because if I have to make an adjustment on one side and then the market completely reverses crazy on the other side, I could probably close out that what was once the bad side. I can probably close it out for a nice profit. So it really helps, keeping the volatility up for that type of trade. For the monthly Weirdor, I've got more time to make up the adjustment, so that helps. But with this one, it's just pretty difficult. So yes, so Suresh is asking, presume you'll continue to add conditional adjustment order in case it's needed. Yes, I will, but it won't be the same. So let's go back here and I'll show you why. And then I'm going to show you another way that I might enter the trade as well, depending on what the market's doing. There might be another better entry. So let's just take a look at the beginning of this trade. All right. Now if I look at the beginning of this trade, here's the original method. My theta is 24, my vega is negative 153. So most of these trades are going to be negative vega. So I know that if the market moves down, that this T plus 0 line is probably going to drop a little bit. Now I'm going to make money on my put debit spreads because they're closer to the money, and the vega is going to help them. But it's not going to help. It's going to hurt my put credit spreads, right? If I look at the, which is why it's important, in the original version, to get that conditional order in and just make sure it gets filled, make sure it gets triggered, without too much of a move down, especially at the beginning. Now, as the trade progresses, for instance, if the market was just kind of moving around in this area for like a week, well, I'd probably be out of the trade because it would have made its profit. But if it's moving around here for a while, and then it moves down, I might have a little more wiggle room before I need to get that triggered. But for the most part, in the original method, I'm going to need to get it triggered at a pretty, 10, 15 points below where I started the trade. With the put condor style, I've got a lot more room to move, and my vega is a little bit less, I have less short vega, and I have more theta. So the theta to vega relationship is a little bit more beneficial to the trade. And then as time goes on, and I need to make any of these needed adjustments, so to speak. So let's just move forward here, a week or so. My vega is getting less and less. Obviously, that's going to happen because of getting closer to expiration. It's even happening here in the original. But it has more of an effect. So here I've got, in the original I got 32 to 138. In the put condor style, my theta is growing as well. My vega is going down, but it's more of a substantial change. It's getting closer to that one-to-one relationship. So I don't have to have, I know that in a very short amount of time, my adjustment point might change. So I might have a conditional order put in at the beginning, but that trigger point will change very quickly, even after a few days. It may change to be a little bit lower. So I might have to adjust those conditional orders. So it's not going to be exactly the same, and it's giving more room to roam. But of course, I definitely will give a heads up if it's getting close. But the nice thing is I got more room to run on these, and they're going to be all of them are not going to look exactly like this on entry. They might look a little different. So it just depends on what the pricing is at the time. But they should all look very similar. However, they might start off a little bit closer to. Uh-oh, I'm having another internet issue? Please no. Okay. They might end up, starting a little bit closer here as opposed to, let's see, when I started this trade, on the 26th, let's see where the market was. It's about 15, yeah, so it might be, instead of being here, it might be a little bit closer here, but it's still giving a lot more room to either side. All right, so that's a nice, obviously a nice benefit of the trade, of doing it this way as well. Now I just want to show real quick too another way of entering this trade that might come up. I might have to enter it this way if it's, just I'm going to pick whatever way is more beneficial. Most of the time it's going to be as a put counter, but this is another way to do it. And if as the market changes, this might be, the better way for that particular month. So let's take a look at this. Oops. This is a spread entry. So what's happening here is instead of, so if I want to pick strikes that are further out of the money, let's say I'm more concerned about downside risk or something like that, or depending on what kind of pricing I can get, maybe instead of picking a short at the 25 delta, I still want to go down further. Here's a 13 delta. But I want to protect that with my put debit spread. So another way of entering this would be to do it this way, where I'm entering two spreads, a put debit spread and my put credit spread. But I have a 1-to-4 relationship instead of a 1-to-10 relationship. So remember in the original method of just entering a Weirdor, I'm entering one put debit spread per every 10 put credit spreads. So here's a 1-to-4 relationship. Now this one's going to have to use more of a margin, but I can lower this. I can make, I can say that this is, I can change this to 6. And, maybe make this 1, but maybe 30 points. Oops. Make that 1. This is going to be negative. Sorry. There we go. But I can lower the margin that way. So something like that. It's not a perfect example, but basically it would take on 2 spreads. This could also be completely cut in half and start off with a margin of about $6,000. Now the way that this one works is, let's say I am moving forward here. I put these 2 spreads on, so it's very easy on entry. Just put on a couple spreads and then, kind of let the market do its thing for maybe a day, maybe just a couple hours, see what's happening. Well, in this case, the market moves up a little bit. Oops. That was, so let's go back a little bit here. So, so let's say I entered this thing in the morning, about 8 o'clock in the morning, and the market, I kind of see what's going on with the market. So later on in the day, I can then add my call credit spread, especially if the market goes up. I think I added it a little bit later here. Should have clicked on that. There we go. So now I can add, so there's actually, there's 3 parts to this order, but they don't have to be entered all at the same time in the morning. So in other words, this is another way to enter this type of trade. It's still, your Weirdor strategy. It gives you more room to the downside here, but as you can see, the T+0 line is a little more rounded in this version, so it's a little more like the regular Weirdor, but it's it has its benefits. It just depends on what kind of credit I'm getting. So this is another method. So I would just enter, the way I would do this is I would put in both the credit spread and the debit spread orders at the same time, and then whatever one filled first, put them at mid prices, whatever one fills first, get the other one filled. And then, let the market settle a little bit, and hopefully, if it moves up, that's even better. Add the call credit spread. And again, this one would be, around a 12 delta. In this case, it's a 10 delta here, but I'd put it on a 10-point strike. So again, that's, pretty decent flat, 40 theta to 158 negative vega. So again, a negative vega trade, bring in a little bit more credit. Target exit date 14 days to expiration. Oops, let me move this out of the way. Obviously some decent profit potential there. So with this one, let's just see how this played out. Let's go to the next day, the 27th. So, the market kind of moved in a little bit here. Now we know that on the Monday, at the end of the day, so everything's looking good, up already 2.3% on that Monday. we go to the end of the day, as you guys recall, we had that big move down. Well, that caused, again, it caused that, oops, that's the put condor didn't do anything to that one, but for the original method, I had to put that put debit spread on because it triggered my adjustment point. But on this one, not quite at an adjustment point, still really flat delta, looking pretty good, up 3.2%. I mean, in essence, that could be removed, although, again, I don't really trust end-of-day prices. Let's go through, the next day. We know the market, actually, let's go through the morning, because we know the market continued to go down in the morning. But as you can see here, it's still, pretty decent delta. I could have made a slight adjustment here, but it was just not quite never became quite necessary in this trade to make that adjustment. But if I did, I would be, adding some kind of a put debit spread just to kind of flatten that out a little bit, something like that. Just a slight adjustment, bring the deltas down almost completely flat, still have my theta and my vegas barely changed, and still have the ability to make a nice profit here. In this one, there are some benefits to doing this particular trade, doing it this way, and I'll get into that more. Actually, Dan Harvey and I are going to be talking a little bit about something like that coming up soon. But all right, so let's just take this, a couple more days further. So and then we had this reversal. So here I hadn't had to make any adjustments. So that means I didn't have to reverse any adjustments, as opposed to if I take that to the original trade, I've already had 2 downside adjustments and 3 upside adjustments at that point. So that's what's hurting that one. So here I am, 3.2%. Let's go another day here, the second. Market keeps going up, but it's nice and flat, so there's no reason to make any adjustments here yet. And then, let's say I take it in Thursday. At this point, it's just like there's really, I'm up 4%. I would just be closing this trade. Just looking for opportunity to take this trade off. And this is kind of interesting. I guess actually at this point I probably would be making a downside adjustment here. Unless that is some kind of weird, sometimes I don't trust the data. It could have been an adjustment point. I didn't do any adjustments on this just to show what it looked like, but that could be, oops, wrong way. That could be an adjustment point there for sure. Flatten that out. But again, still, leaving lots of profitability. So, couple, could have been done earlier or could have been done on that day, making an adjustment. But it wouldn't have cost that much money. It wouldn't have taken a lot of profit out of it. So, if I go forward a little bit further, this trade is up quite a bit, and would be definitely removed, and in this case it would be 7 days in the trade. So both of those methods would work. I will pick whichever one is the best method on entry. It gives me the best looking graph, and in this particular case I most likely would have picked the first one to put condor. I like that graph a lot better. So those are 2 different ways that I'm going to be doing these going forward. I'll probably be starting a new one, what's today, Wednesday? I'm going to look tomorrow actually to see if there's a good opportunity to get in on this new modified version of a 14-day starting tomorrow. And then as far as the existing 14-day, which has been giving me a headache, I probably should have just gotten out of that yesterday. On any pullback, that thing's gone. Hopefully there's not going to be a big run up tomorrow morning. And if there is, I'm just going to have to, either way, I'm going to have to take a loss on it, but unfortunately more of a loss than I had anticipated. There's really not much I can do to adjust that. Going into next week is the week of expiration. I don't want to take any chances. The only thing I can do at this point is probably roll it to a different cycle, which, I might roll part of it to a different cycle just to try to, lower the loss a little bit, but I don't want to get too crazy with it. And I'm trying to get back to simplifying things, which is my normal mode of operation, is to keep things kind of simple. And because of what's been happening these 14 days have been kind of a little more challenging and have forced me to kind of, I shouldn't say forced me, but I've gotten off track with them, and I need to get back on track and get back to simplicity. And this new modifications will do that. So you guys have any questions? I think I answered. Yeah, thanks, Michael. Let's see, I thought about margin. We have reduced margin by 50%. Is it an idea to have one trade every week? Yes, I'm still planning on doing one trade every week. The only thing that I've noticed is a lot of people trade the monthly Weirdor. So by putting it, I'm going to try to avoid putting any of these trades on the monthly cycle because of that. I don't want to step on the monthly Weirdor because a lot of the folks in the everybody signed up for all three strategies, and for those that only signed up for the 14-day, I opened up the other two strategies for you guys because I know it's been kind of a challenge to begin with, and I wanted to give you some more things to look at. But I don't want to step on that monthly cycle. So I think I'm just going to keep these to the weeklies and the quarterlies. And the nice thing is that the entry for these can actually be done a little bit closer to expiration as well. So I have, so I have a choice. So if I go back just real quick, I'm finishing up here. If I go back here to the 26th, so I got 29 days expiration. I could also look at entering, a couple days earlier in the May 18th, or go to the 35 days to expiration. So I can look at any of these three cycles so that I don't have to step on a monthly. So if this was a monthly, I can look at the cycle before it or the cycle after it, and should be able to get a decent entry for this particular modification to the strategy. And then of course if there's any week where it just doesn't look like a good entry and I just don't like it, regardless of the different methods, I'm not going to enter a trade. But there should be some good opportunities to do it with the put condor style or the combination spread style. So if you don't have any other questions, I think I'm done with that. Hopefully the recording worked. And hopefully you guys could hear my voice throughout. Let's see, Suresh is saying 14-day did prove to be quite challenging for you. Yeah, quite of a challenge for me and all of us, I would imagine. You'll try it out again. Great, Suresh, that's great. Yeah, and like I said, the monthly Weirdor and the nested iron condor definitely are more forgiving because they have more time, and of course the nested iron condor is does great with the big choppiness of the market as well because of the method that I trade the type of trading style. The new versions, I plan, Michael, to put that on probably tomorrow or Friday. And if for some reason I don't see a good entry, it'll be early next week, but I'm pretty positive I'll have a new one on tomorrow or Friday this week. Awesome. And I think, yeah, so that's it. Any other questions? All right. Well, thanks for joining, and I appreciate you putting up with the sound kind of going on in and out. I did want to mention real quick before you all leave that Dan Harvey and I are going to be we're going to be working on some new classes, which are going to be really fun, that might turn into services. We'll just be doing some roundtables on that probably in the next few weeks to a month or something like that. We're putting some things together, and they kind of go. One of the things we're going to be talking about kind of goes along a little bit with that little combination thing I showed you earlier, but even shorter term, which is going to be kind of fun. So hopefully you guys will tune in and watch some of those roundtables that are going to be coming up. So I just kind of want to give you a heads up on that. So that's all. Okay, great. Have a great night and rest of the week, and look forward to putting on the new trade hopefully tomorrow. Take care.